First Asset Education Series. Fruit baskets, ETFs, and liquidity. A simple explanation. Before we can start making comparisons, let's talk about ETFs. What is an ETF? An exchange-traded fund, or ETF for short, is an investment that tracks the value of a basket of stocks. ETFs trade throughout the day just like stocks. Because of this, some people assume that the liquidity of an ETF is measured like a stock using trading volume, but this notion is incorrect. The liquidity of an ETF is dependent on the liquidity of underlying stocks that make up the ETF. This is due to the unique feature of ETFs, the ability to increase or decrease the supply based on the demand. This process is called creation and redemption. ETFs and fruit baskets. To simplify the process of buying and selling an ETF, we are going to use a fruit basket metaphor to illustrate this process. Take a look at this produce display. Each fruit represents an individual company's stock. A fruit basket contains a specific selection of fruit based on a predetermined strategy. For example, an index. This selected basket of different fruit represents an ETF. The price of the fruit basket, the ETF, is based on the price of all of the fruits, the stocks. When the prices of the individual fruits increase, the price of the fruit basket goes up. And purchasing fruit baskets from this fruit stand represents the process of buying ETFs from a brokerage firm. To sum it up, the individual fruit is a stock, the fruit basket is an ETF, and the fruit stand is your brokerage firm. Now that we have all of the metaphors explained, we can move on to the unique properties of ETFs. ETF, creation and redemption. To purchase a fruit basket, an investor heads over to the fruit stand and looks at the fruit basket choices. Once the investor has decided on a basket, the fruit stand owner, who is the broker, goes to the market to fill the order. The investor pays the fruit stand owner, receives his fruit baskets, and is on his way. That was easy. But what happens if the investor wants to buy a much larger order? Let's start again with a different scenario. The investor approaches the fruit stand and this time places an order for 100 fruit baskets. Once again, the fruit stand owner goes to the market to grab the baskets. But this time, there aren't enough fruit baskets to fill the order. To solve this dilemma, more fruit baskets can be created at any time. This is the ETF creation process. The creation process begins when the fruit stand owner needs more baskets. The owner lets the warehouse manager, who is the market maker, know that she needs additional baskets. The warehouse manager calls over to the basket designer, who is the ETF provider, and lets him know that they need more baskets. The basket designer constructs the baskets using individual fruit from the market. These are bundled according to the specific selection of the chosen basket. Once the basket designer has created 100 of the requested baskets, he delivers them to the warehouse manager, who in turn passes them on to the fruit stand owner. She can now sell the fruit baskets to the investor. The unique creation process of ETFs means that even with large orders, the cost of each basket stays approximately the same, and the creation process does not require any time or effort on behalf of the investor. It automatically happens in the background. Simple and easy. Now, if the investor wants to sell the 100 fruit baskets, another unique feature of ETFs is used: the ETF redemption process. In this illustrated world, the fruit baskets never go bad and can be sold back to the fruit stand owner at any time. When the investor sells his baskets back to the fruit stand owner, she brings the baskets to the market, but the market's full. Now what? The warehouse manager takes the baskets and gives them back to the basket designer. The basket designer separates the baskets into the individual fruit and sells them back to the market. And because of this, the supply of fruit baskets is in line with demand. Just like creation, the investor sells his ETFs and the redemption process automatically happens based on supply and demand. So for the investor, buying and selling ETFs is a simple, straightforward process. ETFs, A summary. The process of creation and redemption allows ETFs to trade like stocks with the added bonus of retaining liquidity. The trading volume of an ETF does not indicate or measure its liquidity. The creation-redemption mechanism means you can buy or sell many thousands of shares at once without regard for previous volume, one of the beauties of ETFs. And that concludes our explanation on the basics of ETF liquidity. We hope that this explanation has helped you understand the ins and outs of ETFs. Thank you for watching.